Good afternoon, everyone. Welcome you all for post-Union Budget 2025-26 analysis and its implications for trade and industry. Before we start the session, let's watch film of FTCC. Thank you. I now request President of FTCC, Dr. Suresh Kumar Singhal Garu, Chairman of Direct Access Committee, CA Sudhir VS, Chairman of GST and Customs Committee, CA Muhammad Irshad Ahmad Garu, to welcome our speakers, Srimati Venu Madhavi Muppala, Sri Amit Kumar, Srimati Pallavi, onto the dais. I now request the President and the Chairman to present the plan to Pallavi Paul. And to Sri Amit Kumar. And to Srimati Venu Madhavi. Thank you, sir. I now request President of FTCC, Dr. Suresh Kumar Singhal Garu, to give welcome address.
Good afternoon to all. It gives me an immense pleasure to extend my warm welcome to our speakers, Srimati Venu Madhavi Mupallaji, Shri Amit Kumar Pitkariwal, Srimati Pallavi Palji, my colleagues, CA Sudhirji, VS Chair, Direct Access Committee, FTCCI, CA Mohammad Irshad Ahmadji, Chair, GST and Customs Committee, FTCCI, and Trimale Garu, Advisor, GST and Custom, I think, is there. Custom Committee, FTCCI, distinguished delegates, Srimati Nirmala Sitharaman, our Finance Minister, Government of India, presented her consequent 8th budget in favor of farmers, youth, MSMEs, and women and the middle class people of our country. The budget initiatives are pro-industry, pro-consumers, and gives a boost to many sectors. A notable historical decision of reducing income tax rates considering middle class individuals, which is long pending demands, also provides a great relief to salaried employees. The tax exemptions up to income of rupees 12 lakhs gives a thrust to consumption expenditure, leading to increased demand for goods and services benefiting industry. On this occasion, we are happy to share that recommendations sent to Government of India by FTCCI through pre-budget recommendations memorandum were included in the budget concerning reduction of income tax rates, rebate, benefits to MSMEs, customs duties, exemptions, etc. FTCCI, being industry association, is welcoming the union government decision of revising the MSMEs definition and encouraging and supporting MSMEs by new schemes. The experts who are present here today will explain to detail the implications of the proposed budget on economy, direct and indirect taxes. I am sure that the deliberations will be useful to the members. Thank you.
Thank you, sir. I now request CA Sudhir V.S. Garu, Chairman of Direct Access Committee, to give introductory remarks on direct tax proposals in the budget.
Good afternoon, all. The afternoon has already been cold. Okay. So welcome all for this budget deliberation. I think this is the last budget deliberations on the old law. That is, I'm already calling it old because new is already in the pipeline. No, not it. Yeah, whatever. The name I'm saying. So the 1961 Act may not be there. So this is the last deliberation on the 1961 Act. What we are going to do. Good, yeah. So there have been a lot of proposals which we have seen, and I think the individual employees have got a bonanza this budget. So, and many other changes have been there. I was going through the finance bill and trying to get to my portion of indirect tax, but it took a lot of pages for me to scroll. So it appears direct tax has a lot of changes. So we have Madam Venu Madhavi here for taking us through all these changes here. So please do take the best advantage of it and get all your questions clarified. Thank you.
Thank you, sir. I now request CA Mohammad Irshad Garu, Chairman of GST and Customs Committee, to give introductory remarks on indirect tax proposals in the Union budget.
A very good afternoon. President of FTCCI, my colleague Chairman Sudhir, distinguished speakers and distinguished guests some of the senior professional colleagues, Bhutada ji, Samamurthy ji, so our committee member, our past chairman, Mila Jayadev ji, we welcome you all. So it's truly an honor. Friends, as you know, I think the background of the budget, very little is there for the indirect tax proposals, because every year for GST we have 3-4 budgets in a year, so we don't have much to cover in these budgets. So, but again, certain critical, crucial proposals were made in customs law, and more particularly in the income tax law also. So as we know, we have been experiencing subdued demand in consumer market, particularly consumer durables and consumer not durables. We have been hearing about lower demand, etc., and etc., particularly car sales, electronics, etc., and etc. So there was a dire need to boost household income, savings, and also investment. So with this background in mind, so I think some of the drastic changes that have been introduced in the budget is increasing the floor rate of income to be taxable income. So the floor rate is now about 12 lakhs rupees. I think FTCCI under Sudhir's chairmanship has requested for 9 lakhs exemption. So more than 9 lakhs, it is beyond everyone's expectation. I am sure Mr. Samamurthy also did not expect this. No. Yeah. So for salary, it is a big boost. It's 12,75,000, and for TDS also for rental income. So there will be a good numbers in P&L in coming days, and also there could be a rapid changes in the loan market also. So, but one thing that we should keep in mind, there is a silver line. See, 1 crore they are going to lose. Finance Minister, 1 lakh crores. Excuse me, 1 lakh crore. So Finance Minister is going to lose. But again, if you see the numbers, so last year tax revenues, share of tax revenues was 25 lakhs crores. And our target for next year is about more than 28 lakhs crores. So after losing this 1 lakh crore, we still have expectation of gaining another 3 lakhs crores extra. Is it not? So therefore, we should keep our eyes open whether they are going to achieve these revenue targets by increasing the base or by increasing the litigation. So that we should be very careful, or maybe pressure. But see, true, very true. So 4.4, but again 5.5 is the deficit now. 4.5 was the target. So academically it is less than 4.5, but we have to wait and watch because there is global pressures there. But one important point which Finance Minister has pointed out, which was not pointed out earlier, is rolling back the regulations. So achieving a trust-based economy where there is a principle, proven innocent until guilty. They want to move to proven guilty until innocent or proven innocent until guilty. So then they want to go to the assumption that until proven that someone is guilty, that it is assumed that they are innocent. Right now it is reverse. When you go to any department, tax department or GST department, first assumption is you are guilty. And and then you have to prove. So this is the target which government has laid out. Why? Because the main reason is they want to simplify doing business in this country, because there is a growing demand that doing business in this country has become very difficult due to enormous regulations and many other problems. So therefore, one of the target that they have set, which they have not explicitly stated in the budget, is rolling back the regulations. We have to wait and watch how they are going to roll back the regulations. So basically, when they increase the volume, maybe revenue may be achieved, or if that is not the plan, then we may see so a lot of fits and fights between taxpayers and the department in coming years to achieve that revenue target. So coming back to this indirect tax proposal, see, we have seen there is a rationalization of customs tariff structure. My friend Mr. Amit will go deeper into this rationalization of customs tariff structures. And more importantly, they have introduced timeline for provisional assessment, which is 2 years now plus 1. Earlier, there was no timeline for provisional assessment. And there are few sectoral exemptions that they have extended. Again, why? The reason is simple. We are witnessing tariffs imposed by the US. They have already imposed tariffs on Canada, China, and Brazil. So maybe Mexico, yeah. So maybe India is in pipeline. Now, in this backdrop, and then there is again one more thing, friends. We have to acknowledge the fact that globalization is in retreat now. So everyone is thinking about their country. So we may witness scaling back from the globalization principle. So from that perspective, the idea behind introducing these measures in indirect tax is to boost domestic manufacturing, because we don't have any choice left now. So previous budget, there was utmost importance given to the skill development, because as we know, we have a lot of workforce, but majority of the workforce lack critical skills. Even accountants, they're not available in the market. So therefore, this budget also, they have proposed for 5 new national skill research centers to boost the skills. And also, they have lowered the customs duty on critical raw materials which are required for production of certain critical components. So in case of climate change, they have proposed exemption of basic custom duty on cobalt and lithium, which are used with the rare earth minerals which are not available in the country, which we don't have any choice but to import. So in all these areas, they have introduced these measures to boost local manufacturing to avoid the effect of the tariffs which are going to come in near future. So I think these are my comments, my friend, these days, and thanking for your attention. And I wish you all the best, and I hope you will go from this place with a lot of value addition. Thank you so much.
Thank you, sir. I now request Sri Samamurthy Garu to introduce speakers for today's session.
After hearing good afternoon from many members, I just want to wish you all happy Vasant Panchami. Today is Vasant Panchami, Knowledge Day. We worship. Lot of people go to temple in the morning. Probably you all have gone to temple, and now you are coming to knowledge treasure, where churning of knowledge happens now. Budget, churning the budget. So Gnana Saraswati is all sitting here. So in simple, sir, before you give your lecture, to sum up the budget in 2 words, somebody asked, you sum up the budget in 2 words. If you put the 4 table into action, it is slab. And if it is 5 table, it is tax rates. 0 to 4, 4 to 8, 8 to 12, 12 to 16, 16 to 18, 16 to 20, 20 to 24. 4 table in action for slab. Very simple, sir. Itna simple kabhi nahi rehta. So 4 and 5 table are in action. So that is only gist of the budget. Now I take the ardent task of introducing our today's speakers. Dr. Pallavi Paul Madam is a technical director at BSR Company LLP. She has doctorate degree from Indian Institute of Management, Ahmedabad, masters in economics from Calcutta University, specializing in econometrics. First time padro, madam. Econometrics. She has around 24 years of experience, of which first 5 years were in energy. Econometrics में energy भी है ना, specifically electricity sector, and the last 16 years in transfer pricing with a focus on BEPS 1.0 and BEPS 2.0, as well as ESG tax. He is a member of the Energy and Environment Committee of Bengal Chamber of Commerce and Industry and ESG Committee of CAA of Bengal chapter. Now I introduce second speaker of the day. Ms. Venumadhavi Muppala is a partner in E&Y. India Tax and Regulatory Services, a seasoned professional with over 20 plus years of experience specializing in direct taxes and corporate laws. Her expertise lies in tax advisory, strategy, and guiding multinational companies through entry, compliance, transaction advisory, and exit strategies. She has also played a pivotal role in steering companies through digital transformation. Now, the third and indirect taxes. Now, why direct taxes two people and indirect taxes one speaker, because the direct collections have exceeded the indirect taxes collection. So that's why, and every quarter we will be getting that GST Council meeting. So 4 budgets we will have for GST. So this is this thing. Mr. Amit Kumar Fitkariwal is a partner in indirect tax practice at Deloitte and is based in Hyderabad office. He has over 20 years of experience in the field of indirect taxes. Mr. Amit is a commerce graduate from St. Xavier's College, Kolkata, and a member of Institute of Chartered Accountants of India. He also holds a bachelor degree in law. With this, I introduce all the speakers and open the dais. Thanks.
Thank you, sir. I now request Srimati Pallavi Paul, Technical Director at BSR & Co LLP, to take session on finance and economic perspective in the Union Budget.
Hello, I will take up on the Vasant Panchami greeting rather than good afternoon. So I would be just taking up on, although I do transfer pricing, I'm not looking at tax today. I leave it to my panelist who has more experience in tax than me. My economics background is what I will use today. I will take limited time because I'm sure here everybody is more interested in the tax bit. So having said that, so I have a few slides. So my first slide looks into the economic survey, and then I will be looking into some pointers on budget. So my presentation is not analysis. It is just that I have certain takeaways from it, which I would like to just place here, and we might have a discussion. I will put in my thoughts. Yes, I am a little cynical about numbers and budgets and economic survey, but at the same time optimistic, because there are certain possibilities which things remaining constant or things happening the way we want to, we can see a really bright future for India. Having said that, if I go to the key takeaways from economic survey, we once again talk about a resilient economy. While we talk about that, of course, the good part is fiscal deficit over the years have seen a little decline. Forex reserves look stable. GDP growth is a little below expectation, but here again, one thing to think about is, given the global parameters that are all over, like all the economies are in a flux, and this could, and at the same time we have good relationship across all countries. So this could be our time. Of course, as we just mentioned, Trump has applied tariff. India could be in the line. It's still not there. But of course, our relationship can delay it. So it is for us to see how we can take advantage of this kind of situation. I will elaborate a little on that when I come to a next slide on industry. Next, we are talking about robust forex reserve. Yes, we have, I think, anyway, so I have this first slide. I had a different slide which did not come here. But so when we talk of forex reserve, it is stable at the current moment. But yes, we still have our exports are not as much as we would want, and imports remain high. Our biggest imports is one of the biggest are oil and gas, which is a big outflow. Now, having said that, so we have to see how we balance it. But right now, our reserves is in good shape. Next, if we talk about the next thing that we saw was there was an impetus on our labor, as we said, labor force, there is a lot of skilling that is happening. But at the same time, the question that happens is we have to look at two parts of it. It's the quality of work that is happening. What is the kind of work that we are doing? Is it high end or not? Because our biggest competitor being China in that sense, from labor perspective, they are way ahead in various things. Say core manufacturing, they are way ahead. Even in IT sector, they have used their resources to come up with a counter to a chat GPT, which we haven't. Although, we are the ones who may be supplying the biggest brain drain to US, but we still haven't. So, that is where maybe we need to focus on. And we have a scare of AI taking over jobs, but AI is a facilitator. So we have to see how we effectively use AI to benefit the labor and skill them to use AI more effectively to get a competitive advantage and be a front runner in all the sectors. And after that, the only other thing here I would talk about is the renewable sector. So yes, there is major focus, even in economic survey, they have talked about focus being on nuclear, wind, solar. This is absolutely the need of the day because we should be looking at clean tech manufacturing. Manufacturing needs to be our focus to move ahead at this point in time, and clean tech manufacturing sort of ties in with what our targets are in terms of reaching the SDG targets, reaching our 2030 commitments in the Kyoto Protocol, in all these climate change actions. So yes, the economic survey sort of covered all these parts. Now coming to the budget, so yes, as I mentioned, the GDP growth is not as expected. I will have a few pointers on that in the next slide. Then we are talking about, we have the headline inflation. Yes, the headline inflation is something we are seeing is under control, but that is because of retail sector more than the food inflation. That still remains a concern. After that, we would be looking into the fiscal deficit, which I said is in good hands. Then we have our, if I talk about direct, indirect tax, there are a lot of incentives happening. So that is something we should try and capture on. Forex reserve seems stable. Having said that, let me just look at certain possibilities. So when we talk about our GDP growth, as I mentioned, that we have strong global relation, be it Europe, be it US. China is improving for a change because our Chinese ambassador had very nice things to say recently. Yes, US and BRICS are in loggerheads, tariffs being put in, China having a 25% tariff right now. Now, the question that I would just place out here is, so China would want to still send, because their biggest market is US in some sense, would they be, now given that our relationship with China is better comparatively versus what it was maybe a year, 2 years back, would they be using us as a conduit? Because we are unfortunately even today more of an assembler than a core manufacturer. Would they be using that as a base, send their semi-finished goods, complete it here, and via this route go and target the US market? That's a possibility, and that is for us to look at. Of course, US is not a goal. They would be seeing that, but yes, but there are ways in which we might be able to use this as a means to look at our GDP growth, optimize on it. The other part is the decline in Bangladesh. So we have seen that most of the manufacturing that was happening there is slowly shifting to India. Can we use that as a dividend? That is something we might want to focus. And of course, Europe has been in a long recession, sluggish growth, which is again an advantage that we can take care of. So that is our possibilities on seeing an improved GDP growth. Now, coming to our concerns in terms of our inflation. That is an area which I still feel a concern, because our household income hasn't actually increased in that sense, although direct tax is making sure that we have more disposable income. But the food bill in most of our cases have doubled. Now, that is not reducing. Like even for all of us, our food basket, which was even 2 years back, whatever it was, the price of most of the fresh vegetables have never, even in the peak season, have not reduced to what it was. So food has doubled. For us, maybe in our disposable income, the percentage of food in our expenses is not as high as in other lower income group or middle income group. So is it something that we need to take care of? That is something we need to focus on. As far as pricing of vegetables and goods are concerned, so recently we got, there was interaction I was having with my household help. So she just returned from her village and she had a good example. Like we were talking of potatoes not reducing from 20 rupees. She said that right now we have a fresh crop of potatoes. So now what they are doing, the government is, they are selling for 100 rupees some 10 kgs of potatoes, but they are putting it together with other vegetables so that it is not visible that actually they are trying to get rid of the old potatoes at a rate of 2 rupees per kg. So, you know, there are middlemen, there are hoardings happening. So how do we tackle that? How do we take care of that? That is something I think is a ground level, last mile intervention that needs to be taken care of. Now, the other concern is, as I said, the food bill being a major part. Is it increasing our inequality between the, the higher income group and the lower income group? And on the face, it is that there is so much of incentivizing of, say, high-end goods like motorbikes, which are getting imported gold jewelry. There are a lot of tariff reduction in them. So the indicators are a bit confusing, if I may say. And as far as food is concerned, there is a bit of a concern in terms of doctors' children become doctors, CAs' children become CAs, but do farmers' children become farmers? So, and on top of that, the farming incentivizing the kind of crops, the pattern of crops are changing. Is it impacting the food prices? These are certain things I think we have to focus on going forward. The other part was the direct indirect tax. Yes, that is an optimistic outlook because yes, it has increased my disposable income. This tax relief with this disposable income, which is a big chunk is the young kids coming into the job force. Now, what are their spendings on? Okay, spending given, we also need savings at the same time, because without savings, the banks don't have money. So how are we incentivizing that? That is something we need to look into closely. Yes, as Sir Ahmed mentioned, that the retail sector was in bad shape. This relief is surely going to give a boost to the retail sector. The rural sector still had a bit of growth. It is the urban sector that was seeing a slowdown. So this disposable income hopefully will give the required impetus that is needed to see retail sector doing good. Yes, and which I mentioned in the last time, the twist in the tail is, yes, the confusing bit is high-end goods being given incentives in terms of lower tariffs. So why? What is it that we are wanting by increasing the import of such goods? What is it that the government is trying to do is something that we need to deliberate on. Here I have certain thoughts that I just want to place before you on the three sectors, basically the agri sector, industry sector, and services sector. In agri sector, my concern remains that we have been the agitation that we see happening in Delhi over and over again by farmers. Let us go and look into it in a slightly detailed manner. Are they the minimum price offtake that we are talking about? If we do a deep, detailed analysis, it still remains a real surprise that actually the price that they are getting on offtake, which is assured, is lower than a market price. Why? Where is the formula going wrong? They have used a formula which has price indices pegged, but there is a twist in there, so it needs to be revisited. So this price index, minimum price offtake, needs to be revisited. And given that our agriculture sector is an interplay of various things in terms of weather, and given that AI can be used actually to see, which crop can be grown where, how much weather impact is happening, what is the condition of the soil. Can we effectively use that and come up with a better solution which actually ends up helping the farmers out? Because whatever said and done, we can be focusing ourselves on manufacturing, services, look at a high GDP growth, but without a base agriculture sector which is sustainable, stable, the economy cannot sustain itself. So I think we need to look at that minimum price very closely. Coming to industry sector, as I mentioned, my worry is that we are still being assemblers. How do we move to becoming core manufacturer? Because to compete with China, which is actually 28% of global manufacturing, we are at 2.8%. How do we reach there? Yes, maybe we won't reach 28%, but 2.8% is also not where we want to remain. But as we move up towards a higher percentage, we need to move again from assemblers to core manufacturers. We need to develop, do R&D, create the ecosystem where we can actually do basic manufacturing and not just get parts, import parts, and then sell a assembled finished good. And lastly, coming to services sector, of course, GCC is something Hyderabad is talking about. This is the next boom post Bangalore, because most of people are looking at Bangalore being choked, so they are looking at Hyderabad, and it is a welcome incentive also with the GCCs coming here. But the question remains, we not only want to do these kind of work, but we want to do a high-end kind of work at GCCs, not the kind of work where we are just getting inputs and delivering as low-end job workers. Can we move up the value chain, which will increase our return? And also at the same time, what we need to look at is the work life. Is the services sector eating up of our work life? I'm sure all of us have gone through this 70-hour, 90-hour kind of questions constantly. Does it make sense or not is something we need to focus on. Yes, the high-end work is something that we yes. Yes, he has a different take, but the others were talking from, I think, more of IT sector, which is a different ball game actually. So yes, we need to figure out how we do that balance. Yes, they are, but we don't know what Tech Mahindra is doing, right? But you might go and see that there might be some CEOs, they're delegating. So I don't know whether they do 90-hour work. But of course, see, today's world is working on targets. So I'm sure my esteemed panelists from Deloitte and Ernst & Young knows the same story. So we are talking of targets, and the funny part is targets have reached such a phenomenon that even doctors and litigation assessment officers are also given targets. So is that the way to go about it? Is something that we should be looking at. But now, after the budget cut, I don't think they will be looking for too much of a salary increase, because 12 lakhs per annum is, I think, the most lucrative salary right now you will have. Having said that, this is sort of my last slide where I have looked at a few more thoughts. Yes, infrastructure is something that we have strengthened, we have focused in our budget. My only take on this is that, yes, we are doing a lot of Vande Bharat, new roads where we are trying to do connecting everything. But I think we should take a pause there and go back and revamp our existing infrastructure. The rail lines, the rail tracks, the safety of them, the various safety measurement that we have in our railway system, that needs to be taken a look at. Because I don't think at this age we still want to look at railway collisions happening because of signal issues. That is what I think we need to take a pause. Instead of moving forward, I think we should, for a brief period of time, go back and revamp on what we already have. Next is, another thing is that we are mindlessly, you'll see all cities, there is a lot of infrastructure happening. Metros, monorails, flyovers with funny stories like in Mumbai or railway bridge where they are not meeting. So why don't we just check our feasibility study before we go in there? Are so many investments required? If required, what is the benefit I'm getting out of it? So yes, I think we need a revisit to those feasibility studies. Because recently there was huge news articles saying that the metros that are happening all over in all cities, tier 1, tier 2 cities, are they really needed? Because the metro railway stations are happening, but beyond that, the connectivity to your location is not there. So there are the last mile connectivity is what is required. And without that, these are just white elephants sitting there with no usage. So what is the point in investing? Is it just a electoral kind of a mandate? It should not be, because it is a huge investment we are talking about, and it's all taxpayers' money. Next is the incentives that are happening. Yes, EV sector has seen a lot of incentives. We are looking at EVs, Tata Motors, Mahindra, all going into there. But the question still remains. We are talking of a sustainable system. Is EV really sustainable? Because there is a lot of research going on hydrogen cell, which is more sustainable, because lithium mining itself, if you look at the entire supply chain, it's not the most sustainable kind of way of working. Because EV1 is the raw material is very water intensive mining. Secondly, when you are charging, you are again using those. Right now, we do not have a renewable kind of a mix in our electricity sector. We are still heavily dependent on thermal. So we are looking at increasing the demand for that. So is this really sustainable or not is a thought that we need to put in. Shipbuilding has been incentivized. The question is, why the sudden focus? Have we really done our feasibility study and looked into it? Is the railways, which is our bread and butter in the sense, it is the bedrock of India. Is it the railways, are they incentivized enough already? I think a cost benefit analysis needs to be done. The other is the electronic sector, which has incentivized, but making of chips. Who's making those chips? Isn't it time that we start doing it ourselves instead of just importing it and incentivizing import of chips? That is another thought I would leave here. And lastly, education capacity increase, which is a lovely thing. Skilling, training, everything is increasing. Number of seats in IITs has increased. Technical studies are increasing. But at the same time, we need to focus on few things because it's a nightmare after these scams in NEET and various other admissions that the objectivity in screening process should increase. Secondly, the curriculum. I don't know whether our curriculum is still very globally competitive or not. So we need to look at that. And thirdly, do we have enough teachers to teach this crowd and create the workforce, the kind of intellectual youngsters, the youth dividend that we have to optimize on that youth dividend? Yes, this is an area we need really a clear deliberation in a proper manner. With that, I will close my presentation. Thank you.
Thank you, Madam. I now request Sri Meela Jaydev Garu, immediate past president of FTCCI, to come on to the dais for presenting moment.
Madam, just a minute.
Thank you, sir. Thank you, ma'am. I now request Srimati Venumadhavi Ampala, partner at Ernst & Young LLP, Hyderabad, to take session on direct tax proposals in the Union Budget.
No, we have the first slide in that way, sir. That's the reason for it. Warm good afternoon. I'm sure each one of us were looking forward for this budget with a lot of expectations and also a lot of excitement. And I think the finance minister had held that expectation or the excitement towards till the end of the budget. Very unusual of the sequence that she took the direct tax proposals towards the end, whereby a lot of things were installed in that part. Okay. On that note, one important, if you look at overall, what's the big picture looking like if one has to dissect it? Of course, everyone were expecting that the direct tax code, there will be something in this budget whether she'll be announcing that, okay, this would be implemented, or will she pass the direct tax code, etc., so on and so forth. Okay, multiple expectations were around it. I think she had unfolded that part saying that, okay, the new income tax bill will be released this week, most likely, and it is not that it will be out for the public comments, which was the expectation earlier, but it is very clear that the bill will be passed this week. And the intent or the objective while passing that is also very clear that she made a specific remark there saying that half of the sections will be reduced, the half of the literature will come down, lot of simplifications will be there in the language and the way it has to be interpreted. And that is one of the major things which she has considered while making that statement. Apart from that, of course, the other expectation which was there from all the salaried class of employees was also that, okay, will there be any exemptions or anything, the slab rates, etc., will there be any changes? Most of them had expected around 9 lakh to 10 lakh. So it went beyond the expectations to 12 lakh. Of course, there are some aspects there in the fine print. Probably if one does the math, is that really a benefit which is coming up to all the employees is also something which one has to look into. The next one is with regard to the gift city. Lot of amendments have come up for the IFSC units. A very welcome move there because the industry was looking towards the gift city. The next one is with regard to ease of doing business. Of course, the TDS and the TCS provisions, lot of amendments have come up there on the thresholds and also removing the TCS provisions, etc., omission of some of the provisions. That's something which has been done in this budget. Yeah. I think Sir had rightly put up at the start, as far as the concessional tax rate, the new regime, if one looks at closely, right, it's the 4 table and the tax rate which has been given as the 5 table. So if we closely see 4 lakh, 5 lakh, 12 lakh, that's how the limits have been put up. So it's very clear math there. Okay, very easy to remember, unlike our earlier slabs which used to be there. That's one thing which has been considered in this. One important point here is that there is no change in the surcharge and the education cess. So whatever have been the amendments in the slab rates, it's only for the individuals who have opted for the concessional tax regime and not for the ones who are still have adopted the old tax regime. There are no amendments as far as the old tax regime is concerned. There is a small comparison which we tried to put up here on this slide to see how much is the tax savings versus the current provisions and the proposed ones. So any employee who is having 12 lakh salary, of course, there is a rebate under Section 87A, because of which the 12 lakh limit is where you have the, there is no taxes there. So that's why there you see a complete tax arbitrage there of 83,000. But any individual who is crossing around, to be more precise there, an individual who is having a taxable income which is close to around 12,73,933.5 rupees, in that particular situation, that is the break even. Beyond that, any individual who is having more than that gets into the maximum marginal thing, and thereby you don't see much of the tax arbitrage there. So for any of the individuals who are in the mid-management category or any individuals who are in the top management category of any of the organizations, probably you may not see that benefit of that 12 lakh exemptions which was heard in the budget. Some of the other proposals which have come out, which are very much relevant to the individuals, is also in relation to the income from house property. So there is already an existing provision under Section 23, subsection 2, which clearly states that if an individual is having 2 homes, okay, 2 house properties, and because of XYZ reasons, the reasons are also clearly mentioned there, that because of an employment or because my business of operations is in some other place, etc. Because of those reasons, if the particular house property has not been occupied, then the deemed annual value of that property, the rental values, can be considered as nil. Okay, but now they have done away with that. There is no such conditions which have been attached. So any individual, say take for instance, if I had 2 house properties and in one of my house properties, my parents or in-laws have been staying in that property, and here we are staying here in the Hyderabad city, even in that particular circumstance also, for both of the house properties, the annual values can be considered nil. So irrespective of any of the criteria, it can be considered 0. So that was the amendment which has been brought in. The next one is with regard to the perquisites. There is an amendment here under Section 17, subsection 3. So earlier, this was almost like 15 years back, is what the threshold limits had been given here. That if an individual is traveling overseas for a medical treatment, there was a limit that the salary component of that employee, excluding the perquisite values, should not cross 2 lakh rupees. Then the perk will be considered 0. Okay. So those limits is something which will be prescribed shortly. Of course, there is nothing as such explicitly a number or the quantification which has been given in this budget, but the limits is something which we will see a change there. The next one, of course, is a very welcome move for all the individuals who have children who are studying overseas, because especially in this particular context, we see that many of the individuals, when they are sending the funds out of India, there is a TCS levy which comes into play there. Okay, that is something which has been done away with, provided if that amount is being taken in the form of a loan from the financial institutions, and then what is the funding done to the children's education. So earlier there was a 0.1% which was levied. Now that is something which has been done away with. Apart from that, the overall thresholds also for the foreign remittances earlier was 7 lakh rupees. Now that has been enhanced to 10 lakh. So this will be applicable, like say, could be for tour package. If anyone is traveling overseas and has taken a tour package, which is less than 10 lakh, probably the TCS would not come into play there. The next one, which is very much relevant, is in the context of individuals who have covered themselves under the NPS scheme. So in the erstwhile provisions, there is already a limit of, so you know that there is a 1,50,000, which is a general one, and there is another 50K, which will be given under FTCCI, which is in the context of when the individual is contributing into the NPS. Okay. Now what they have added is that if the individual has contributed for the NPS for the minor, so they brought in this new scheme, the NPS Vikasit Bharat. So this was there even earlier also, but those things were never covered under that 50 limit. So limit has not got enhanced. This coverage has enhanced. That's the only change there. As far as this section is concerned, this deduction is something which is there even in the concessional tax regime also, and it is not just in the old tax regime. So any individual who is covering under the concessional tax regimes will also be eligible for this deduction. The next one is on the national savings schemes. So there was a circular which was released by the Ministry of Economic Affairs on 29th of August 2024, wherein they had mentioned that any amount which have been accumulated in that scheme will not be eligible for the interest with effect from 1st of October 2024. So because of this, all the individuals who had invested into that scheme were looking for a withdrawal, but the section is very clear that if you are withdrawing that amount, there is a levy of tax for the individual. So there was a holdback. So in order to plug that is what they have come up, and they have mentioned that there will be an exemption which will be given if you are doing the withdrawal from that scheme. And this is a retrospective amendment with effect from 29th of August 2024. The next one is with regard to the unit ULIPs. So this is something which has already been there. Probably I would say that this is more of a clarificatory in nature, wherein they have explicitly mentioned that any gains which on account of redemption of the ULIP, which are not exempt under 1010D, they will be considered as capital gains. So they brought in an amendment under section 45, subsection 5. So that's where the amendment has come in, wherein they have plugged in and they have made it more of a clarificatory. So as far as the limits are concerned there, the premium which is in excess of 2.5 lakhs will not be eligible for that exemption thing. So anything, if your premiums have been more than 2.5, so that will come under the category of capital gains. So this is something which has been brought in with effect. While it is clarificatory, they have brought in with effect from the coming assessment year 26-27. Okay, the next, this was from the individual's taxation standpoint. Now when we look at from the presumptive tax, there is a new provision which has been brought in here. The provision says that if a non-resident has been rendering services to any company, it's only for the services which are rendered to a company which is exclusively focusing on electronic manufacturing. So it could be in the process of setting up. Mainly this is to target the semiconductor space. That's how we are looking at it. So any company who is in the process of setting up or is already into the operations, and there is a non-resident who has rendered services, okay, they have given a specific benefit of presumptive taxation. Now, what was it erstwhile? If one has to really dissect and see there, we used to say that, okay, if the individual is coming from a particular jurisdiction where India has a treaty, we go back and see the treaty rates from a withholding standpoint and also from a taxability perspective. Okay. So an individual or a company who has been rendering this kind of services which fall under FTS or royalty, if the tax rate which is given under the treaty, we pick up the treaty rate, right? If it is, that is more beneficial when compared to the Income Tax Act. Now, in the context, if the non-resident triggers a permanent establishment in India, then we get into the details there and we see that, okay, what is the net amount which that company or an individual who has created a PE here, what is that amount which has to be subject to tax? It's the net base income which comes into play there. And of course, the tax rate then gets into almost around 35% being the base rate plus surcharge and cess, somewhere translates to around 38-39%. Now, that is the law which was there. From that law, now this is the new thing which they have proposed for those NRs, non-residents, that they can go under the presumptive taxation wherein 25% of their income will be considered as taxable income. And on that is what the taxes will be levied accordingly at the rates in force. Now, there is a specific point to observe here is that they mentioned that if the non-resident is carrying on the business in India, so whether this provision will be applicable only in the context, whether when the non-resident creates a permanent establishment or a business connection in India, in that particular context only is what the presumptive taxation comes into play, or is it also in the context of non-PE scenarios is also something which is a point of debate here. Most likely it should be only in the context of PE scenarios. Unlike in the other cases, it should not trigger ideally. Now, they have not restricted the scope of services to say for the incomes under fee for technical services or royalty, they told any nature of income. So, erstwhile, we used to take the benefit of the treaty also that time, where we used to say that, okay, while this is an income which is not falling under fee for technical services or royalty, this has to be considered as a business income for us. But since there is no PE, then we say that, okay, this need not be subject to tax. In that kind of scenario also, will the presumptive income triggers is also a question of debate here, which is very unusual. Ideally, any non-resident would not like to take this path because when I have the treaty benefit, ideally the non-resident would prefer to take that benefit only in the context where the non-resident is coming from a jurisdiction where India does not have a treaty. Probably this could be the route which the non-resident would like to look at. As far as this amendment is concerned, this amendment will be with effect from the next year itself. Of course, that is assessment year 26-27. Now, the other thing is with regard to the tonnage tax, I know this is mainly in the shipping industry. Of course, we used to have only the vessels which are in the international waters, which used to get covered. Now, inland transportation is also something which they have tried to cover within the ambit. That's the add-in which they have brought in, wherein those companies also can look at having the tonnage tax scheme. Next, moving on to the concept of simplification or rationalization, if we look at, we just tried to put up some of the sections here. Of course, the tax rates have not undergone a change in any of the sections. It's only the thresholds which have undergone a change, which you will be usually seeing at, say, something which is at a 5,000 rupees has got enhanced to 10K, etc. So that's the changes. And when it comes to if I move on to the next slide, there is some interesting point to note here is that typically in the concept of rent cases, okay, we used to have an overall threshold limit of 2.4 lakh during the financial year if the thresholds are cross, then there is a withholding which comes into play. Now they have made it that it has to be 50,000 per month. So anything which is crossing that limit only is what the withholding comes into play. So probably if one is reading this particular section, please don't consider it as like, okay, 50 into 12. Okay. That's not the case. It could be that in a particular month, probably if you have moved from one location to the other, etc., those kind of aspects also come into play here. Okay. A very interesting point to note here is that if I have to correlate this back with the earlier thing where I refer to as a self-occupied property, say an individual, I just would like to illustrate here something. It's just a food for thought probably, which each one of us can think through. If I as an individual is a salaried employee and I have opted for the concessional tax rate, for sure, I will not reach out to the landlord, okay, asking for PAN details, etc. Okay. Now, in that particular circumstance, the landlord, on the other hand, also has the benefit of having the two house properties being declared as self-occupied. Okay. Unless and until the department gets into the details there, probably one does not get to know whether this is something which is given on rental basis, because I, who have occupied that property, I'm also not submitting any of the documents there, which is relating to my rental agreements, etc. Versus the landlord also, if this is being, in a way, this comes into as a cash transaction and not as a banking transaction. So in that way, the withholding also would not be there. And at the same time, for the landlord as well, the rent which has been triggered on that particular property will also come out of the tax net. There is certainly a loophole here as the way this has been worded right now in the proposed bill. Moving on to the other simplification measures which have been undertaken. One is on the TCS. As we all know that there is a TDS on levy of on sale of goods, and at the same time there is a TCS as well, right? But if at all if TDS is collected, TCS need not be done. Right. So that's the interplay between the two sections. There used to be a lot of tussle here as to whether the other party has deducted the TDS and has deposited or not, etc. There used to be a lot of back and forth on that point. So now what they have done is that it has been proposed that the TCS will be done away with. As far as 194Q is concerned, there is no amendment there. Only in the context of TCS on sale of goods is what they have done away. And this would be applicable from the financial year 25-26. The next one is in the context of non-filers of returns of income, be it from the TDS standpoint and also from the TCS perspective. We had exclusive sections there wherein it specifically highlighted that the TDS has to be withheld at a higher rate if the other party has not filed the returns, right? So whether the other party has filed a return or not, taking a declaration or having a proof, etc., was a tedious task there. So that is something which they have done away with, both under the TDS as well as the TCS provisions. The next amendment is in relation to virtual digital assets, section 214A, wherein they have mentioned that virtual digital assets will also consist, basically they have expanded the scope to include the crypto assets also into the ambit of virtual digital assets. Now, India is being, so there are around 52 countries wherein all the countries have come to a consensus. These 52 countries have come to a consensus that there will be an exchange of information between these 52 countries with regard to the crypto asset transactions. So in order to implement that is what they have incorporated a new section, section 285BAA, wherein it is mandatory that any individual, basically any SSE or any person who has the transactions in the crypto assets, they have to disclose those transactions. Okay. It could be, for instance, like whether they give a notice, etc., as to how they would be doing the procedural aspects is something which we have to wait and see. But it is very clear that those details is also something which the department would like to have the hold, because India is part of that, wherein India has to give exchange of information to the other 51 countries there. So that's the objective as to why they brought the crypto assets into this budget. The other amendment here is with regard to the significant economic presence. Now, as you all know, under Section 9, there is something called as the concept of business connection, right? So when we look into the details of the business connection, there is a specific carve out that the income will not be deemed to accrue or arise in India in the form of a business connection if there is a transactions in relation to where the people have procured, and with the procured, so non-resident has procured from India and with an objective to export. Okay. So under the business connection definition, already there is a carve out. But when we read the way the provision is today drafted, it says that any significant economic presence also, that also comes and fits under the definition of business connection. So the way the significant economic presence is being worded, there is no carve out for those kind of transactions. So that is the reason why they brought in this even under the significant economic presence. But the if we look at the objective or the intent, this was already there. It is more of just to bring in that harmony between the two is what they have brought in this amendment. Otherwise, this was already there in the Act itself in the form of business connection, the carve out. The next one is with regard to the startups. As far as the startups, the clause under Section 80 IAC, this is something which they have now enhanced there. So earlier we used to have the limit, the cutoff was March of 2025. Now they have enhanced it to 2030. So any startup which has the certificate from the IMB will be eligible for this deduction, provided their turnovers does not cross 100 crores in the relevant financial year, and at the same time, this benefit is applicable only for 3 out of the 10 years. So as far as the section reading is concerned, there is no amendment. It's only the time limits which have been enhanced. The next one is a very interesting one. So this is with regard to carry forward of losses. This deals with majorly 3 sections: 72, 72A, and 72AA. Okay, 72AA is mainly in relation to banking. Probably I'm keeping that aside. If we read the provisions of 72 and 72A, 72A explicitly deals with amalgamation, in the context of amalgamation, in the context of demerger, and also in the context of business reorg today. Okay, that is how the section is. So when it comes to, in the context of amalgamation, it is being mentioned that if, say, a company A, which was a loss-making company, which has ensured that it satisfies all the conditions of industrial undertaking, etc., company A merges into company B. So company A would have generated those losses way back, like say 5 years back or so, but there is a fresh life of those losses for an 8-year window when company A gets amalgamated into company B. So from the year of amalgamation is the 8-year window. That is how the existing provisions are worded. Okay, while you will not see it very explicitly, but there is a reference given to the year of amalgamation. Same is the context even in the case of business reorg also. Business reorg, what they mean is in the context when the firm converts into a company, or when the company gets converted into an LLP. In these two contexts also is something where it has been mentioned that there is a fresh life for those losses. So most of the companies, what they used to do is that when that 8-year window is coming to a halt or a sunset, so they used to look at having the merger, thereby a fresh life used to come in. Okay. Now, that is the trend mostly in the case of amalgamations. Okay. when we see from a demerger standpoint, demerger does not give reference to the year of demerger. It just says that, okay, whatever was the loss, since it is a demerger, it gets split into two different companies. So the loss of company A, some portion will be retained in company A. Whatever is the undertaking which is getting demerged into company B, that portion of the losses go and sit in company B. There is no fresh life concept for those losses which is getting created under the current regulations. Okay, but there are many councils who have opined that even in the context of demergers also, there is a fresh life which comes in for those losses. Now, amidst all these ambiguities is what there is an amendment which has been brought in this section, whereby they have mentioned that in the context of amalgamations and business reorg is where there is no fresh life. It rolls back to the year in which the year of loss was generated in the hands of the amalgamating company. That is how the amendment has come in. They have not explicitly referred to the demerger provision. The relevant subsection in the context of demerger has not been referred. There is still a room for planning. The next one is in the context of REITs and InvITs. As far as this provision is concerned, today, if you see in the REIT structure or the InvIT structures, we do have certain incomes which are passed through, some which would be subject to tax in the hands of the REIT. So typically in the case of InvITs or a REIT structure, we would be having a trust wherein all the unit holders will be in that trust. Okay. The trust internally at the bottom would be having multiple SPVs. SPVs are nothing but the projects which are being undertaken by the REIT. So either it could be a REIT or an InvIT. So typically, when the fund is flowing from the bottom onto the top, there are few which is like a pass-through in the hands of the REIT or the InvIT. Basically, REIT or InvIT, when I'm referring, is the trust, the in-between trust. So typically, in the context of interest and dividends is what, when the SPV is giving up to the REIT in the form of dividend income, it is a pass-through. So the trust would not be subject to tax. It goes and gets taxed in the hands of the individual in the context of interest. In the context of dividend, there also it is exempt. Okay. So that is the benefit in the REIT or an InvIT structure. Any other incomes apart from that used to get subject to tax at maximum marginal rate for the trust. Now that is something which was slightly a loophole, because REITs at times, not through an SPV, but also would be holding some of the assets directly. So whether when they are holding those capital assets, whether it will be a capital gain or whether it will be considered as a business income was the issue or a debate there. So that is something which they have clarified, saying that if the trust is holding those assets directly and that asset is a capital asset, then any on account of transfer of those will have to be considered as capital gain tax and not a business income. And thereby, of course, you get the benefit of the tax rate of 12.5% versus if it's a business income, it would be subject to tax at a higher rate. Of course, many of the earlier, many of the trusts or the InvITs used to take this position. It was a position which had to be adopted. Now it is explicitly mentioned in the Act. That's the difference. The next one is in the context of investment funds, which is nothing but to do with the CAD 1 or CAD 2. Okay. So if as far as the definition of capital asset is concerned, the definition of capital asset has also now expanded this. They have expanded the scope to cover the investments which are held by the CAD 1 or CAD 2, whereby they will be in a position to get the benefit, which is nothing but it will be considered as a on transfer of those assets, that is a capital asset, thereby it will be considered as a capital gain. In the concept of investment funds, okay, which is nothing but we call it in a simple language AIFs. Okay, AIFs, in the context of AIFs, PG is something which is a pass-through. Capital gain is a pass-through there. So that is the reason why this is something which they tried to cover it there, such that they get the pass-through benefit. Of course, the last one is with regard to the capital gains on FIS, which is to do with section 115 AD. As you all know, in the last budget, we had a lot of revamp on the capital gain provisions, right? So all that, where we had seen that wherever we used to have 10% rate in the context of long-term, on account of transfer of long-term capital assets, from 10% in few of the cases moved to 12.5%. Okay, this was the only section where they missed making the amendment. That is something which has been amended now in this budget. That's the only thing. Of course, but this is again prospective. They did not give a retrospective impact to it. The next one is in the context of transfer pricing assessments. As you all know today, transfer pricing officer determines the arm's length price on a year-on-year basis. Right now, they have introduced something called as a block for 3 years. So I, as an SSE, can go forward and opt for a block of 3 years, or it is at the option of the SSE, to be more precise there. So if at all, if the SSE does not want to go ahead and opt for a block assessment, then the transfer pricing officer cannot implement. As far as the implementation from the rule standpoint, timelines, etc., this is something which is awaited. But one important point here to observe is that this would be applicable for the assessment year 26-27 and the subsequent years. So it is relevant for that particular year onwards. It is not that the TPO, if the TPO has passed any of the orders in the assessment year 26-27, it is not applicable for those prior years. It will be applicable only for assessment year 26-27 and onwards. There is a lot of ambiguity as far as the way this section is being drafted today, because there is something which they have referred. So this provision of 92 CA has to be read back with again 155 subsection 21, wherein they have mentioned that, okay, if there is a TPO order for one particular year, year one, there is a TPO order, and we would like to go for a block assessment for the subsequent 2 years. So SSE has to go forward, make an application. The officer will scrutinize whether it is a similar transactions being undertaken in the subsequent 2 years within a 1 month window, and then they'll pass an order saying that yes, they are eligible for the block assessment, etc. And then is what the assessment happens. Now, if by any chance in the subsequent 2 years, if there was already a 143(1) passed, or if there was already an assessment order passed, then there will be a corresponding amendments which will happen in the subsequent 2 years. That is how it is being worded. But if one looks into closely the timelines, okay, it is very unlikely that in the first year, if the TPO passes the order, in the third year, by year 3, the TPO reference date also will not be able to touch it. So how far is this possible to implement is something, a question which is there. So we have to wait and see as to how this gets unwound in the form of rules, etc. Of course, there is a specific mention in the speech on the safe harbor rules that there will be an expansion, etc. But nothing in the fine print. When I say the fine print, nothing in the bill nor in the memorandum, there is anything reference to the safe harbor rules here. The next one is with regard to the updated tax returns. As we all know that an SSE can file an updated tax return within 12 months from the end of the relevant assessment year, provided there is an enhancement of income, etc., and there is a discharge of tax liabilities. Right. So this has to be. So if we look at the current provision, right, it says that there is a window of 24 months, which is possible now under the current law. So in the first 12 months, the additional tax which comes up there would be 25%. The next is 50%. That's how the current law is worded. Okay. Now they have brought in to add 2 more years into it. So another 2 more years also, there is a possibility for the SSEs to come forward and file an updated returns. Of course, when it comes to the additional discharge of taxes, 60%, and then next year is the 70%. That's how it has been brought in. Now, For which year would this really be applicable, or from which year onwards is there a possibility for us to get covered under the new law? If we look at, it will come approximately around assessment year 21, 22 and onwards. Those years is which there is a possibility for us to get covered under the new provisions. There is one point to note here is that if there is a reassessment which has got initiated or something for that relevant year, there is no possibility for us to file the updated return. Okay. But by any chance, if that has been dropped off, okay, because of any glitch, like we have seen a lot of litigation surrounding the initiation of the reassessment proceedings, right? If by any chance, if that has been dropped off, those years also, then provided if we fall within the time limit of 48 months, you will be in a position to cover them. Okay. The last one is with regard to the gift city. So a lot of amendments with regard to the gift city has been brought in here, mainly focusing on, because many of the GCCs, the so-called GCCs also are planning to set up there in the gift city, thereby they get the tax arbitrage. So in terms of having the operations being commenced, there was a sunset clause for us here, which was 25. So that is something they have given a 5-year jump where they have enhanced it to 2030. That is one amendment. That's the basic one. The next one is with regard to, so currently in the existing law, we have for aircraft leasing companies already a benefit which has been given. Now this has been extended even to the shipping leasing companies also. And as far as this provision is concerned, this would be applicable from the current year itself. When I say current year, I'm referring to financial year 24-25. The next one is also with regard to 24-25, a small point which I would like to highlight here is most of the GCCs today have treasury operations also, where they're trying to bring the finance SSC centers into India. Okay. In Hyderabad market also, we see many of the GCCs, while they're doing ITES, they also have parallelly finance SSC centers set up in India, whereby they're rendering services from India even to the overseas geographies. So as a part of that finance SSC center, the tax COEs also came in. So any matured finance SSC centers also started looking at bringing tax also into the ambit of SSC. Thereby, they're addressing the tax laws of the overseas jurisdictions also. As a part of that extension, most of the companies started looking at why can't we bring the treasury operations into India? So if India becomes a treasury hub for a particular group, for a large group, so is it okay to have set up the treasury operations as a unit in the Indian entity, which is today already a GCC sitting here in India? Or would it be appropriate for us to carve out that as a separate company? Was a question which most of the companies had been deliberating in the last few months, because IFSC had come up with this particular benefit getting passed on. Okay. Amidst all that, it was not very clear that if the company which has set up the treasury operations here, and if any of the group companies require funds, they have to give that in the form of loan or advances, right? That's the separate entity. Indian company is a separate entity, and the rest of my other sister concerns which are there across the globe, they are separate entities. So either it has to be in the form of loans and advances. So there always used to be a cash, whether this comes and sits in the form of deemed dividend provisions, section 222E. Okay. So if that is housed outside of gift city, that catch was there. Even if it is in the gift city also, there was a catch. So to plug that is what they have brought in, saying that if the treasury operations are housed in the gift city, and from there any loans and advances are being given to any of the sister concerns, then it will not be considered as a deemed dividend. But one important point to note is that the parent company, okay, the ultimate parent company has to be registered one, okay. It has to be listed on the stock exchange there. In that particular situation only is what this benefit has been passed on, that it will not be considered as a deemed dividend. This amendment is also with effect from the current year itself. The other welcome move which had come up was in order to encourage the non-residents to take the insurance policies from India. They also brought in an amendment here in the gift city itself, wherein if there is an insurance company located in the gift city and the non-resident has taken insurance policies, any sum which will be paid back, right, at the time of settlement, there also there is an exemptions which have been given. That is also something which they have incorporated in the current budget. And that is also with effect from financial year 24-25 itself. The other one is with regard to the tax exemptions with regard to the non-residents. So currently we used to have for the non-residents who had the derivative transactions with the banking unit were already exempt. That is already there in the current law. Okay. So if a non-resident is having derivatives with a non-banking unit, which is to be qualified as an FPI in the IFSC zone, even for them, the exemption has been extended. So that is more like an extension which was there earlier, of course, which was only confined to banking units, has also been now moved to the non-banking units also. So these are the amendments as far as the IFSC is concerned. I think with this, I come to the conclusion.
Thank you, madam. I now request Amit Kumar sir for proposing indirect tax proposals in the budget.
Good afternoon, everyone. So as my previous colleague and speakers, they have already where all the customs, since it is currently out of GST, and so that's the main exercise where it is done through budget. Wherever any legal amendments or any tariff changes, anything needs to be done, that is generally done through budget exercise. Second, to implement the GST Council decision, because GST Council is body which decides what changes should be there, and any changes which basically require legislative amendment, like if any changes in the sections and all law, that requires the approval of the parliament in the state legislation. So that is always done through the budget exercise. And apart from that, of course, if there are any changes which is there in the excise, which is still there on the petroleum product, so not there are any issues which are and government wants to put on, which are generally taken by GST. Yeah. That the wording used in section